Aloha! We're coming to you live from the floor of the Hawaii Tax Institute. I'm Avina Lowe, Chief Wealth Strategist of Wilmington Trust, and today we're joined by two very special guests, Ryan Janowsky, who is counsel of Schiff Hardin from New York City, and Olga Bogush, who is a partner at Schiff Hardin. Given what we have since tax reform a year ago and the new deductions that's now available to S Corp holders, I feel like S Corp has gotten a resurgence, so to speak, in terms of importance, especially with business owners.
S corporations have become a tool where they can be utilized to obtain a higher 20% deduction than you can in the case of partnerships. The reason for that is because in the case of S corporations, any payments, any compensation payments that are made to shareholders that are also employees, they count towards the limitation that are used to determine the 20% deduction.
Would you recommend people restructuring based on these tax benefits?
I think S corporations should be kind of approached with caution, and because the structure is so inflexible. Once you go into the S corporation kind of construct, it's very hard to unwind the structure, because unlike the partnerships that can be easily unwound with minimal tax cost, S corporation is very difficult to unwind, because to the extent that there is built-in gain in the assets that are within S corporation, then you can't really dissipate it without triggering tax on that gain.
When you have a business owner come to you and say, hey, you know what, I'm forming a new business, right? What are some of the factors or the questions that you would ask them to consider before determining what is the right entity choice?
Some of the things we would want to know is what kind of business this entity would be engaged in, right? Whether the entity would have employees, or whether it would hold real estate, depending on the nature of the business, right? And the desirability to obtain the 20% pass-through business deduction. I think the decision would be made kind of using those considerations.
Can you talk to us from a planner's perspective when you're talking to clients and they do want to plan with S Corp? What are some of the things you should look for?
The first thing we have to speak with a client about is what are the various restrictions that might exist with transferring their S corporation shares? Who is a valid shareholder of an S corporation? This is a very important subject, because if you transfer a share in an S corporation to somebody who can't hold one, or to an entity that's not qualified to hold S corporation shares, you can actually trigger the termination of the S election, which can have some pretty dire tax consequences.
What about in terms of a taxation benefit as it relates to, say, a C Corp? Is there any benefits there?
Well, of course, because C Corps, they're entities that are subject to essentially double taxation, right? So you have income that's being earned by the C Corp. It's taxed within the C Corp at the corporate tax rate. And then when the income is distributed to the shareholders, then it's taxed again in the hands of the shareholders. S Corp essentially is a pass-through entity. So income is only taxed once.
One of the often objections, or I should say hesitation, I hear sometimes from clients about using S Corp is that unlike some of the other entity choice, there is not a StepUp and Basis. How will you counsel clients about that?
It's true, it does not get the same kind of step-up and basis opportunity that a partnership would get. In a partnership, you can make an election when someone passes away that steps the internal basis of the assets within the partnership up to meet the fair market value of the partnership interest itself. With an S corporation, the same event does not occur. You do get a step-up in basis in the stock of the S corporation, but there's a way to structure around this to get almost the same benefit. So the key is that in the year of the sale of the asset inside the S corporation, it's also the proceeds are distributed out of the S corporation.
What are some pitfalls that people should be mindful about?
I think with an S corporation, it's always the inadvertent termination issue. It's just so common, and there are ways to fix it. The problem is that to fix it costs quite a bit of money, because you have to privately seek that relief from the IRS through a private letter ruling. If you inadvertently terminate your S election, it causes that entire pocket of money that was already taxed once to get taxed again. So that's why it's very important to avoid these inadvertent terminations. If you think an inadvertent termination has occurred, to take the right steps to remedy it.